Lake County Investment Advisory Committee meeting. Today is January 9th, 9:45 a.m. Madam Clerk, will you do the roll call, please?
Commissioner Plechnik.
Present.
Treasurer Zorman.
Present.
Commissioner Beveridge.
Here.
We're now going to have the election of President of the Lake County Investment Advisory Committee, and I would like to nominate Commissioner John Plechnik.
I'll second that.
And we're going to have a vote.
Yes.
Yes?
Aye.
So congratulations, Commissioner Plechnik.
Thank you.
Eileen Stanic from Meeder Public Funds. She is going to give a presentation on the portfolio.
Well, good morning and Happy New Year. Hope everyone is looking forward to what should be an exciting ride here in 2025, at least from the market's perspective, i.e. interest rates. So just a little recap here, really, on what we experienced in 2024. Oops. Sorry, I gotta set that down. I think the key here is, as just a reminder, 2024, the Federal Reserve cut that overnight interest rate by 100 basis points, a full 1%. We now have overnight rates in the range of 4.25% to 4.5%. Term interest rates, of course, within the scope of what we can invest in as a public entity, which would be 5 years or less. We've seen the 3-month Treasury bill during the year follow the trend of the Fed funds rate, so that also dropped from 5.33 to 4.31. The 2-year Treasury yield, while there was tremendous volatility throughout the year, it ended the year basically where we started. But the 5-year Treasury showed some considerable strength here in yield as it moved up by over 50 basis points, and we would attribute that due to the results of the presidential election and the market's anticipation for stronger growth going into 2025 and the uncertainty as it relates to perhaps inflation. Before we get into the 2025 view, I just wanted to also tie this in with Meeder. We have been expanding considerably over the past several years, and so at the end of 12/31/23, we advised on $155 billion of public entity dollars out throughout the country, and that encompasses over 400 clients. So by next quarter, I will have the 2024 year numbers, but just to kind of set that as the base. That we are growing off of $155 billion over 400 public entities. Lots of folks who need help navigating this environment as well. Looking at our metrics that we are following here, of course, Fed funds rate as we look into 2025, the Federal Reserve has indicated 2 additional rate cuts would be likely throughout the year, and they would expect that would then put us down to a range of 3.75% to 4%. Market is pretty much on board with that as well, which is very different than what we've experienced here pretty much in 2024, where the market was offering up a different opinion than what the Fed was conveying. But again, we're early on in 2025. Inflation, having come down from its peak, has allowed the Federal Reserve to lower interest rates. It's become a little sticky here, hanging out at 2.7%, and the expectations are that further reductions in inflation will be rather slow throughout 2025. Economic growth has been solid. Surprisingly, but really when we drill down to the factors that have driven economic growth, it's been consumer spending and, of course, government spending, not only at the federal level, but also at the state and local level, as those ARPA dollars are continuing to be spent. And unfortunately, as we know, the devastation due to hurricanes and now fires present will be positive to economic growth once rebuilding does start in those affected areas. Our hearts go out to all of those folks that have been affected by that. Employment picture has started to show signs of returning to normal. Have the unemployment rate of 4.2%, up from its cycle low of 3.4%. We know Lake County has been very fortunate to still maintain a very low unemployment rate. But all this is translated into yields, and as we will see, this Treasury, at least from September, September's low, and I know before the meeting we talked about how rates were very low in September and October, but we're up at 75 basis points, 0.75% from that point, but we're still off of that cycle high, which was in October of 23. So this chart is showing really, sorry, this always happens to me. It's showing the market's expectation for where that overnight rate will be by the end of 2025. So we're looking at this activity over 2024, what the market's expectations were, and this is that volatility of what we experienced in 24, where the market was expecting the overnight rate to really not move too far off of its highs, but then really to plummet again in that September to October time frame. But now we are back to market's expectations aligned with the Fed, which is 50 basis points over the course of this year. It's interesting though, the market's really kind of split today, and again it changes every day, but today it's about a 50-50 likelihood that we would have one or two. So again, there's a lot of uncertainty out here from the standpoint of new administration coming in and what programs will be enacted and how that will impact the economy and the like. Inflation, consumer price index, of course, off of its high back in 2022, and we can see just looking here at the snapshot of 2024 how inflation has come down, but it's kind of started to creep back up again. Top graph is the year-over-year measure of the consumer price index. The lower graph is the month-over-month change, and this is where the market particularly is concerned that will this inflation remain at this level? Will it creep up a little more, or will it continue its trend of lowering? We know the Fed has a target of 2%. They had indicated they did not need inflation to get to 2% in order to start lowering rates. And of course, we know they started that lower path back in September of last year with that 50 basis point cut at that point. GDP, which is economic growth. I'm sorry. Again, as I mentioned, it was been very stable here, but as we look at what the economists are predicting for 2025, slower growth. We want to keep in mind that historically trend growth for the U.S. economy has been 3%. So growth in the mid to lower twos would be below trend growth, but still positive growth. So this is kind of a little contrary, one would say, to what the market's overall expectations are, which is stronger growth, which of course has led to higher interest rates on the longer term. Jobs, Fed has two mandates: stable prices, that's the inflation picture. The other mandate is full employment. And one of the pieces that looking at with the labor market position is the initial claims for unemployment and the continuing claims. And so the initial claims for unemployment have been very stable relatively of late. These are also, I would say, not showing any warning signs, and same with continuing claims. So when we think in terms of the outlook for the labor market, we believe it will remain relatively stable, in balance, like it has somewhat returned to. Last economic slide here is just looking at the 2-year Treasury yield, which is the bottom line, relative to the Fed funds rate. Again, Fed funds rate is what the Federal Reserve controls, versus the 2-year Treasury is a market rate, and that's in benchmark security that we do track. And we can see, as I mentioned, the volatility in that yield in 2024, volatility defined as the yield moving very quickly from month to month. But we're in this environment now where the 2-year Treasury and the Fed funds rate are pretty much approaching par, we would say, par with each other. So our time period of the inverted yield curve has passed at this stage. Moving on to the county's investment portfolio. At year end, we ended the year with $298 million in cash. Now that does include funds related to the bond and note proceeds as well as the engineering utilities.
Oh, Mrs. Stanic, yeah, I wanted to point that out. I'm glad that you mentioned the cash position. There is about $120 million included in the that figure for cash, which is directly from Safety Service Center bonds, which we need to hold in that position for payments. So that's why that number is much higher than previous meetings. So thank you.
Yeah, so right, when we strip that out, as well as the engineers and utility funds, that number, cash number is closer to around 115, 120 million. Securities portion is the 279 million. Securities are invested in, when we look at the asset allocation, in securities that are permitted under Ohio Revised Code and the county's investment policy. Just kind of stepping back on the cash component, the cash is also invested. It's invested in a liquid investment option between the local banks as well as the Star Ohio Investment Pool, which is like a money market-like fund that's available only to public entities. The securities portion has a weighted average yield of 3.7%. That's up from the prior quarter at 3.45. As you may recall, we had just under 14 million maturing last quarter. Those funds were reinvested with an average yield of 4.59. So that gives you an idea of, as we're reinvesting funds, it's at higher rates. That's accretive to the yield. Considering that, when we think back up until 22 and 23, rates were, or 21, 22, rates were extremely low. We were looking at, basically 0 to 1%. So clearly our lower yielding investments are rolling off of the portfolio at this stage and are being reinvested at higher rates. And we can see that particularly when we look at the bottom graph, which is the maturity distribution, which includes the yield associated with each bucket. We can see that the longer term holdings that we have beyond 2 years are all yielding on average about 4%. So with that, that completes my report. Is there any other questions or comments?
I'd like to thank Eileen, Stanic, and